You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Most options trading platforms are commission-free, and there are some that don't charge per contract fees. Public.com goes a step further. When you trade options on Public, there are no commissions, no per-contract fees, and you get a rebate of up to 18 cents per contract traded. That means it costs less than $0 per transaction. In other words, instead of paying to place options trades, you literally earn money, and that money can add up fast. If you trade 1,000 option contracts on Public, you'll earn up to $180 in rebates. 10,000 contracts? Up to almost $1,200. It's pretty obvious why NerdWallet recently gave options trading on Public 5 out of 5 stars. Because Public really stands out for the cost of its options trades. Their words, not ours. If you want to start paying less than $0 to trade options, check out Public.com and get a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody, welcome back to Options Boot Camp. Yes, it is Education Wednesday. Time to put on our hats and our whistles and do a little bit of options basic training. My name, of course, Mark Longo from the optionsinsider.com, as well as from the network upon which all of you folks have been and continue to binge, have been since, 2007, we've been doing this options podcast thing. So podcasting since before, not only was it not cool, no one even knew what the hell it was. And trust me, I went around to a lot of the big firms in the world of options and derivatives and indeed just finance back in 2006 and early 2007 to say, hey, I'm doing these podcast things. What do you think? No one had any idea what language I was speaking. So yes. Podcasting since definitely before it was cool, and certainly since before most people knew what the hell it is. Of course, if you want even more podcasting goodness in your lives, listeners, only one place to go. Wherever you're getting this show, make sure you upgrade to the full network. That'll have nearly a dozen shows coming at you. Especially for the listeners of this show, it is more important. There's so much great content there that will arm you with information about futures options, about crypto options, about volatility, about unusual activity in the markets and what's trading, more education. Our buddy, Mr. Uncle Mike, of course, does the strategy block every Monday on the Option Block show. We also have hundreds of episodes of Options Playbook Radio waiting there for you. The Advisors option, which I just got off with our buddy, Mr. Matt from Oratz, who's a popular guest on this program. He had some fun things to say about zero DTE yesterday and how are they impacting the overall risk in the market? Well, you have to check out the Advisors option on the full network to hear that for yourselves, listeners. But fascinating stuff. Make sure you're doing that. And if you want to go above and beyond, I know a lot of you have, head on over to the pro, theoptionsinsider.com/pro. Great pro Q&A yesterday with a buddy, Mr. Vixologist, going deep into all your questions about volatility and all the products they're in. And there are a ton. And the devil is in the details with all of them. So if you want to hear that, you want to hear options oddities every week with myself and the Rock Lobster, you want to get live streams, you want to get all sorts of giveaways, early access to stuff like the content coming out of the OIC conference that I recorded a few weeks ago. All sorts of fun. TheOptionsInsider.com/pro is the place to go. I got so excited I forgot to mention our review last week on the episode. So I'll get there now because we don't get a chance to mention a lot of our international listeners. This one was translated from French, I believe, 5 stars. I don't know what platform, but it says excellent program. Oh, looks like Jean P, but I'm guessing because it's French, it's Jean P. So Jean P says excellent program, great knowledge from the hosts on options. Well, thank you, Jean P, and everyone else who takes the time to rate and review. And if you want to check out some more options goodness, you know where to go. MarketTaker.com, from whence we are joined by the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show, sir.
Hey, it's great to be back.
These double headers are fun, huh? You get in the groove with one episode, and then bam, you slide right on into the next one. It's like an old shoe. You just slide right in, ready to go.
But it smells better.
Yes, exactly. It's not like a bowling alley shoe. This is a freshened shoe. Perhaps riding a bicycle would be a better metaphor, sir, as we keep on rolling right on into a little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, Mr. P, let's get down to it, listeners. It is time for a little bit of the basic training. And today's topic, listeners, is another one that we are revisiting, not quite from as far back as last week's episode, where we went all the way back to the primordial ooze days of 2015 and indeed 2013, talking about trading options and IRAs. But we're going back a little bit farther and to the halcyon days of September 2020. Oh, what a great year 2020 was. We all can remember it so fondly. Episode 102, listeners, it was entitled Gamma Scalping for Beginners. You could tell from that what our topic is today. Yes, we are going to revisit Gamma Scalping. Why? Well, Dan did it for his question of the week a few weeks ago, and it kind of got the wheels turning. I know a few of you responded to that, had some questions. And Dan had mentioned also his thoughts and his, shall we say, lack of love for Gamma Scalping, especially for those folks out there like most of you in the retail accounts. And it's certainly a mindset that I share. So it seemed like it was a good time to revisit it here on the show. Dan, I have some thoughts, but before we get there, you are responsible for this. You kicked off this Gamma Scalping discussion, so I will let you go first, sir. I will open the floodgates to your vitriol. What are your thoughts on your favorite topic, Gamma Scalping?
Yeah, so Gamma Scalping. Okay, so look, I'll tighten the screws just a little bit on what you were talking about, Mark. Like, is it my favorite thing? Well, in some ways, yes. In some ways, yes, actually, but in a lot of ways, no. That is all I did on the trading floor. I mean, I tried to profit from the bid and the offer, but my second profit source was always being long Gamma. I mean, I preferred to, and I got really, really good at Gamma Scalping. Now, that being said, that was on the trading floor. Since leaving the trading floor, I've barely ever even thought about thinking about it. And anytime any of my student traders talk to me about it, I try and dissuade them because it just doesn't work so well for retail traders. And we can talk a little bit more about some of the reasons for that a little bit later.
Yeah, it is funny when you mention it that way, because when you think about it, I was like you. I would say many days the lion's share of my profits or mitigating the losses came from Gamma Scalping. That's what we did. When it was a slow day, not much going on, when you're just slinging 10 lots here and there, waiting for big orders to come in, you can't really make a lot of money trading the bid and the offer. So you got to have something else. And that's where the Gamma Scalping comes in. Now, obviously, Gamma Scalping is a double-edged sword, listeners, because In order to sling all that stock, you have to have some stock usually to begin with. That's costing you interest. So there's a cost associated with it. But I won't go down that rabbit hole. Instead, let's get into some specifics. What the hell are we talking about? All right. Gamma scalping. There's a variety of ways we used to do it. When we used to be market makers, we would put on an options trade. Someone would come to us, let's say, and they say, I want to sell a bajillion calls to you guys in the pit. We say, okay, we will buy them for this price. They say, sold to you. We buy the calls. What do Dan and I do? Do we want to sit there riding all those long deltas all day? No, we do not. So we would sell stock against that, and we would wipe that out. It's called delta neutral trading. Our delta would be zero. But we all know delta is not a static Greek. And if you don't know that, you should be listening to early episodes of this show, or perhaps check out Dan's book, Trading Options Greeks, for an in-depth example of delta and how it evolves. But for a lot of you retail, that's not the way gamma scalping would really work. Let's take a more, let's say, practical example. So let's go out to XYZ. Trading $10. Everyone loves XYZ. Made or lost fortunes in this name. You decide you want to come in, you want to buy 10. So you got a decent sized little position here. A 10 1 month at the money calls in XYZ. So keyword, at the money. What does that mean, listeners? Again, if you've been listening to this show for a while, you should know at the money means an approximate 50 delta at the end of the day. Again, if you don't know that, check out the archives. Go read Dan's book about the Greek. So at the money call, about a 50 deltas. Could be 51, different 49, whatever, depending on where the stock is trading. But it's going to be an approximate 50 delta. So you bought 10 of them. What does that mean? Congratulations. You are now the proud owner of 500 long deltas, or effectively 500 shares worth in XYZ. Why? Because 50 times 10. It's a pretty basic math out there at the end of the day, listener. So now you have 500 effective shares of XYZ. Let's say the stock goes up. Let's say it goes all the way to 20 during the lifespan of this option. So now your $10 calls, guess what? They're $10 in the money. They are deeply in the money. They have morphed from 50 delta to now effectively 100. They're effectively stock. They're not going to be obviously exactly 100. They're probably going to be 99 in your model, but they're effectively 100 deltas. They have morphed effectively into long stock. So what happens now to your deltas? Now that you've rallied, the stock has effectively doubled. Those calls that were 50 deltas, again, they're now deep in the money. They're now effectively 100 deltas. So your deltas have doubled. Congratulations. You're now long effectively 1,000 shares of XYZ, aka 1,000 long delta. So now you have a choice. What do? You could say, hey, woohoo, bought my calls. I'm going to sell these calls, take my profits, and ride off into the sunset a happy camper. I'll thank Mark and Dan for doing this awesome show. And I will go treat my significant other to a nice dinner, whatever you want to do with that money. But you could also say, well, maybe I think the stock's going to come back down, but I don't know. And I don't know if what I want to do with this yet. But so what you decide, might have a little bit of a near-term retracement, but I don't want to sell out the calls for whatever reason. You could sell stock against that. Man, you're long effectively 1,000 shares now of XYZ at 20. You can come in, you sell 1,000 shares of XYZ at 20. Bam. You've wiped out those deltas. You are now flat deltas. So now the stock keeps rallying. If it goes to 40 by expiration, guess what? You're out. You're off the table. Your deltas don't increase beyond 100. You're not going to get any extra delta juice there. But let's say what you hope for does come to pass. The stock retreats right back down, back to $10. Now, what do you have again? You're right before expiration, let's say. The stock that you sold 1,000 shares at $20. Stock is now $10. So hey, $10, 1,000 shares, $10,000. Not the worst thing to have. The calls you bought are going to be going out effectively worthless now because they're back to the strike, right where you bought them for, right where expiration is. So they're not going to be worth that much. So you sold 1,000 shares at 20. You could do a couple of things. You could take the whole position off and make a pretty darn nice profit. In this case, again, it'd be 1,000 shares, $10, 10,000 shares minus whatever you pay for the calls. Maybe it's $1. So then it'd be $9,000 net profit. Either way, it's a pretty good win. And you live to fight another day. Or you could come back in and do the whole thing over again, which would be crazy again, but that could happen again. You decide you want to buy more deltas at 10 and then hope to rebound. And what you're really looking to do, I hope you're picking up on this, listeners, is profit from that vacillation in the underlying and using your options deltas to do it. So why do Dan and I dislike it? It sounds awesome, right? From that example, It's awesome. If that would work out every way that way, listeners, yes. Gamma scalping would be the best thing on the planet. Just buying calls would be the best thing on the planet. And indeed, shorting the stock would be the best thing on the planet. But as Dan mentioned, this is not exactly a retail-friendly strategy. Just listen to what I just talked about. That's tying up a lot of capital. You're going to short 1,000 shares of some stock now. Again, you have the calls against it, but brokers get a little bit iffy these days when you start trying to sell stock short on any position. So they're probably going to margin you. And it depends how option savvy they are as well in terms of how they treat that position. It's just a very capital margin intensive process. You're slinging a lot of shares back and forth, hoping to make a profit. And it's not really conducive for a lot of retail out there. So Dan, that was my best case example of a retail friendly style of gamma scalping. What are your thoughts, sir?
Yeah. The thing with retail gamma scalping is first of all, I mean, you can't do it by trading the underlying because it's just immensely capital intensive. Either buying the stock, even if you buy the stock on margin, you still got to pay half the value of it. Shorting stock chews up a crap ton of margin. And remember, you're trying to make Vega points, which is literally pennies. And that means in order to make any reasonable profit, you've got to tie up massive, massive amounts of capital. And it's like kind of small percentages of the capital that you're tying up. So trading the underlying just is just a no-go. But the other side of that is scalping in and out of the options. Seemingly, hey, maybe that is a good idea, but there's almost no stocks that can make sense on because, again, you're just trying to make pennies, a few Vega or maybe even a couple of Vega points only. And if the bid-ask spreads are like a nickel wide and the Vega is, 6 cents or something like that, I mean, you're just at such a massive disadvantage. And then you factor commissions into there and it's just a no-go.
Yeah, when Dan and I used to gamma scalp, we slung a lot of underlying. We had very favorable margin treatment in our professional accounts and a lot of capital at our disposal to do so. For retail, it is just not the most efficient use of your capital. As Dan mentioned, it's very onerous, it's very expensive. Labor, capital, commission intensive, all the things that are not good for retail. I mean, my example was ridiculous, admittedly, but it's not going to happen that way. So don't use that as an incentive to want to gamma scalp. It's just really, it's something that is done out there. You hear us talk about it. You hear other people talk about it. We want you to know what we're talking about, but effectively not something you should be doing, listening. Instead, what you should be doing is sending in your questions for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, listeners, let's get to it. Before we unleash you folks, let's unleash the market taker. Question of the week.
And now, it's the moment you've been waiting for. It's time for the Market Taker Question of the Week.
All right, Mr. Dan, it's that time, sir. What you got for us this week?
All right, so what happens to your option position if the underlying stock is scheduled to get delisted? Now, this doesn't happen all that often, but sometimes it does. So let's talk about it. So one thing is, if the stock is going to get delisted, I mean, there could be many, many reasons for that. One would be, it just doesn't barely trades or something like that, but then the options would be delisted long before that. So that, I guess that's kind of part B of this question. But it also could be something like maybe the company goes private and it's no longer a publicly traded stock. So I'll caveat this first. Anything can happen. I'm going to tell you what typically happens, but the first thing you want to do is you want to contact the OCC, which is investor services at theocc.com. You just email them because they are the authority. They determine what happens to those options. Now, that said, what typically happens is, let's say there's monthly expirations and there's leaps options. Got options going out, 250 days or something like that, or whatever, more. But you get a circular and it says that the stock is going to get delisted in 60 days. Well, and it's confirmed, right? Well, here's what happens. Those options that had 250 days to expiration, they now have 60 days to expiration. Because when the stock stops trading, the options stop trading. So expiration comes early. Now here's part B. Sometimes the options can get delisted while the underlying still trades. And that's the same thing. If they're going to stop option trading in 3 weeks, 21 days, but you've got positions going out to 58 days, well, guess what? They're not 58-day options anymore. They're 21-day options. And so you have to take that into account. So when you first start hearing rumors of delisting and that kind of thing, you might think about just getting out of the risk of some of the longer term options, or if anything, at least make sure you're not long them, because if they expire early and you're short them, that could actually be beneficial. But if you're long them, that could be a really, really big problem.
Well said, sir. Delisted options. Is that intriguing to you, listeners? Is that worth a deeper dive? I do believe we have touched on that in the archives in the past, but perhaps I shall have to go through and look and see the last time we have chatted about such a thing. But let's get some more questions here on the show. Let's go out to this question here. Let's go to Megaton. I like that name. It's very close, one letter away from Megatron. Megaton wants to know, what happens to the call premium when I sell a covered call? Can I immediately use that capital to make other trades or even to withdraw from the account? Ooh. Mr. Dan, our buddy here, I'm going to call him Megatron because it's more fun. Megatron, he wants to know, when he sells the premium for a covered call, what happens to that money? Can't he just take that money, Dan, and go use it on another trade and then maybe use that trade, sell another call, and then take that money and use it for another trade, and on and on and on in a virtuous, never-ending cycle, sir?
Well, there's another one where I'm going to caveat it. Brokers can handle some of these things their own way, because this is something that relates to margin, and that can be different from broker to broker, even stock to stock within the same brokerage firm. But the first thing you need to know is that it takes until the next day for the options to settle. If you sell the call right now, you don't actually really have that cash until tomorrow, or after the close today, I guess. It's kind of the same thing. I'm just not really sure technically what the difference is. So yeah, you do have that cash in your account, but whatever the position is, there's going to be a margin associated with that. And so, sure, you might have this cash put into your account, but it could be tied up in margin. So it depends on the broker. It depends on the stock. It depends on exactly which position we're talking about, covered calls or credit spreads or naked puts or something. So yeah, there's kind of a lot to unpack there. And I'll tell you what, if you're interested, here's what you do. The next time you're going to put on one of these trades where you're taking in premium, look at the balance of your account, look at the cash, look at the net lick, look at the margin, look at it right then and there. And this is good if you don't have a lot of positions on. And then look at what happens immediately after the trade, and then look at what happens tomorrow morning. Now, the positions may make or lose money, so that could change your net lick and potentially even your margining. So, you're going to have to account for that. How much did this position make or lose or whatever? But that's a great way to do it. Just empirical evidence. Just watch what happens and learn from that trial and error.
Well said, sir. Yeah, there's a lot of caveats to this one. But at the end of the day, brokers are savvy. They're not going to let you just keep using the same capital for legions of trades endlessly over and over again. So unfortunately, no free lunch there. But it is worth checking with your broker if you do a lot of trades like this to see exactly how they treat that capital. Let's go out here to this question from Dak Knower, maybe Denower, all one word here. He says, have you guys heard you guys talking about how call premiums are trading back at levels at or near the 2021 meme stock revolution? Yes, we have talked about that a few times recently. It says, what are some ways we can take advantage of that as options traders? Well, Denower, you are in luck. You came to the right show. I know a lot of people are new, so they don't often take the time to go into the archives and see, hey, is there an episode or two or half a dozen about this exact topic? If you did so, Mr. Denower, and anyone else who's intrigued, you would see we have talked about this quite a few times, including quite recently. Most recently, episode 277, entitled NVIDIA Madness, Binary Craziness, and Revenge of the Meme Stock Skew. It's all there in the title, listeners. That was from February 21st of this year, so just 3 months ago. And then Options Bootcamp 275, so not that long before it, trading options in high skew environments from February 7th of that year. So skew was all the rage back in February. 274, right before that, I should say. More covered call data plus call skew and options rumbles, because who doesn't love a good options rumble out there, listeners? And then before that, go back to 2022, April 27th of 2022. We did episode 183, Swimming Deltas and Sleepy Dan. I love a good Sleepy Dan, and that episode is full of them. And episode 171 from January of 2022, Trading in Volatile Markets and Crypto Book Club and more. So again, there you go, listeners. That's 5 right off the top of my head, just a quick search. Just looking for skew, and you can find that stuff. So again, I know your platforms are all different, how you listen to the show. Sometimes they gate the content in different ways, but if you can search for it, do that. If not, by all means, go to our website. It's easier to find stuff there. And you could search for topics until your heart is content. Dan, anything you want to add here on this whole 2021 meme stock revolution? I mean, it is timely given the trading we've seen even over the last week and a half, Dan.
Yeah. I'll tell you what, that was a funny little period in market history, but there could very well be a resurgence to that. And there were some grumblings about it like last week, because Roaring Kitty posted some very ambiguous picture on his Twitter account. And then consequently, funny little video the day after. I don't think he's posted anything since then. And people were like, oh, it's GameStop again. And they bought up GameStop. And then he sort of alluded to, if you read between the lines, well, maybe it's not GameStop. And so I don't know. These I don't know if it's really right to say thought leader. I think that might be quite an overstatement. But these, what do they call those? Influencers, I guess, stock market influencers. They've got a lot of followers, and they could, one of those events could easily play out again. Not that the memes, not that short squeezes have stopped at all. As a matter of fact, I'm doing a class for our audience on short squeezes tomorrow and also on Saturday. So if you don't follow me, if you're not on my email list, get on my email list so that you can attend that live training. But yeah, I mean, that can play out again for sure. Easy.
All right, listeners, that music means we've come to the end of part 2 of our double header episode extravaganza. If you're listening after the fact, it just sounds like another episode to you. For all our live folks, it was a fun doubleheader. Hope you had fun in there. You want to join them in the live? Check out all the other shows we do, pro Q&As and everything else, theoptionsinsider.com/pro is the place to go. And while you're checking things out, make sure you're heading on over to public.com, public.com. They are the reason shows like this continue for you and have done so for a long time on the network, 17 years on this show, well over a decade out here. So make sure you write to them, say, hey, see you're supporting Options Bootcamp. Tip of the cap to you. Maybe you like the platform, maybe you don't. Kick the tires and light the fires. Either way, let them know you like their support of shows like this so we can keep the content coming to you. Clearly they like it. They've already extended their run and it just started. So clearly they're liking what you folks are telling them over there. Public.com, the place to go to kick the tires and light the fires for yourself. And while you're kicking tires, Mr. Dan, you got any fun tires for them to kick over there at MTM?
Oh, we've always got good stuff going, including that short squeeze class we have this week. So I'd love for you to attend it. Make your way over to markettaker.com and just click join free. We'll send you an email with the link to the class that we're going to have.
Markettaker.com, the place to go. Don't forget the second T for Theta, listeners. You get all the goodies Dan's got cooking over there. That's going to do it for us on the network today. Back again tomorrow with another doubleheader, our usual doubleheader. First off, we've got the option block in the morning with our friends over there at SIBO, talking about all things unusual activity and all sorts of fun. Followed by TWIFO, This Week in Futures Options, where we talk, as you can probably guess, all things futures options. Then back again on Friday with our buddy, the once future and present Dr. Bix, to talk all things volatility and volatility views. And then after that, one final time for the week, exclusively for our pro members, we come back for a little bit of options oddities to talk all the mad trades we're seeing going up in the options market this week. Then we're back again, not next week on Monday because markets are closed for Monday, and not next Wednesday, at least not live, because Dan will be traveling. But you'll get your on-demand episode, don't you worry. And then back again right now in 2 weeks as you're listening to this next week, another episode of Options Bootcamp. Stay safe out there, everybody.
Check out public.com if you want to literally earn money to place options trades. There are no commissions or per contract fees. And Public gives you a rebate of up to 18 cents per contract traded. Discover why NerdWallet recently gave options trading on Public 5 out of 5 stars. And start paying less than $0 to trade options. Only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures and podcast description. U.S. members only. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.